Welcome to The Explainer. Today, we're going to talk about a legal tool that is, and I mean this, absolutely essential for any business with more than one owner. The thing is, it's also one of the most overlooked, the buy-sell agreement.
So, let's just start with a really tough but completely critical question. What would actually happen to your business, your life's work, if your partner was suddenly, unexpectedly, just gone tomorrow? To really get a feel for why this is so important, let's just walk through what can happen. Let's imagine a thriving partnership's absolute worst-case scenario, a situation that can literally unravel everything you've worked so hard to build. So picture this. You've got a successful small business. Everything's clicking, you're building something really special with your partner. Then, bang, the unthinkable happens. One of the owners passes away without any warning. And in that single moment, the entire future of the company is thrown into complete and utter chaos. And if you don't have a plan in place, well, the fallout can be catastrophic. Seriously, you could suddenly find yourself in nasty legal fights with your late partner's family. Their heirs, who could be wonderful people but know absolutely nothing about your business, might legally become your new partners. The estate could demand a massive payout right now, forcing a fire sale of company assets just to come up with the cash. You can imagine what that does to morale. Clients and employees start heading for the doors, and the value of the business you built just plummets.
Okay, that's a pretty scary scenario, right? But the good news is, it's a nightmare that you can completely avoid. And you can do it with a single, proactive document.
The best way to think about a buy-sell agreement is literally like a prenup for your business. It's a plan you put together now, while everyone is on good terms, while everyone's thinking clearly. It lays out exactly what happens during one of these stressful, emotional, and totally unexpected events. It just takes all the guesswork and all the potential for conflict right off the table.
And I want to be super clear about this. This is a legally binding contract. It's not some informal handshake deal or a vague understanding. No, it's a formal, enforceable document that dictates the rules for what happens to an owner's share of the business if a triggering event happens, like death, disability, or even just retirement.
All right, so let's break this down, because a good agreement really does three absolutely critical things. First, it defines who gets to buy the shares, which is huge for keeping ownership in the hands of people you actually want to be in business with. Second, it sets the price, or at least the specific formula for figuring out the price, so it's fair for everybody. And third, and this is key, it establishes exactly how that buyout is going to be funded. It's the complete roadmap for a smooth transition.
So this all sounds great on paper, right? But how does this thing actually work in the real world? Well, it really just boils down to two key decisions: the structure of the agreement and, probably most importantly, the funding.
Okay, so you've basically got two main flavors here. In a cross-purchase agreement, each business owner buys an insurance policy on the other owners. So if one partner passes away, the survivors get the payout and use it to buy the shares directly. This is great for, say, 2 or 3 partners, but you can see how that gets messy if you have 5 or 6 partners, right? That's where the entity purchase agreement comes in. With this one, the business itself just buys one policy on each owner. It's way, way simpler to manage. The right choice really just depends on your specific setup.
And this right here, this brings us to what is maybe the most vital part of the whole equation. A buy-sell agreement without a way to pay for it is just a piece of paper. It's an unfunded promise. Life insurance is the fuel that makes this whole engine run. It provides a chunk of cash right when you need it most, turning that promise on a piece of paper into a real, financially executable plan. It means the surviving owners aren't forced to drain the company or go deep into personal debt.
Now, it's really easy to mix up buy-sell insurance with another tool called key person insurance, but they do totally different jobs. Key person insurance pays the business to help it recover from losing a vital employee, to cover lost profits or hiring costs. But buy-sell insurance is different. It provides cash to the owners so they can buy out a departing partner's shares. So one protects your operations, the other protects your ownership.
All right, so you get it. You see why this is so important. But listen, knowing what not to do is just as critical as knowing what to do. So let's talk about the common traps that can make even the best plans fall apart.
And the number one mistake, hands down, is just waiting too long. It's procrastination. This kind of planning needs to start the day you form the partnership, not when there's a crisis on the horizon. If you wait until there's a problem, it's almost always too late.
All right, mistake number 2 is this set it and forget it mindset. Your business is a living, breathing thing, right? It grows and it changes. Your agreement needs to do the same. A valuation that was fair 5 years ago might be completely unfair today, and that's just a recipe for disaster and disputes. You've got to review it regularly. And the third big one, oh man, this is a costly one, is totally ignoring the tax side of things. How you structure the agreement, how it's funded, all of it has huge tax consequences for the business, for the surviving partners, and for the family of the deceased partner. Not getting professional legal and tax advice can turn a really smart plan into a very, very expensive mess.
So, if you dodge those bullets and you actually do this the right way, what's the end game? What does it actually look and feel like to have your legacy secured with a well-funded buy-sell agreement?
At the end of the day, a proper agreement gives you 4 huge benefits. You get business continuity, so your employees and your clients don't panic. You get fairness, making sure a partner's family gets a fair market value for their share. You get financial stability, so you're not forced into a fire sale or taking on a mountain of debt. But really what it all adds up to is peace of mind. Just knowing that your life's work, your partners, and your family are all protected from the chaos.
Look, you have poured your time, your money, your passion, everything into building your business. So the question all of this leads to is really simple, but it's profound. Is your legacy truly protected from the unexpected? We've laid out the roadmap. Now the only thing left is to take that first step.